Now, in this video, I'm going to break down exactly why this really simple scalping setup keeps winning in live markets, and what's more, when you execute it properly, it honestly feels like a 90% win rate. The secret? Well, it all comes down, in my opinion, to a clean price action pattern followed by a solid retest, and that's where, in my view, the precision kicks in. So stick around if you want, because I'll walk you through a couple of real trade examples so you can see exactly how this setup plays out in action. Now let's kick things off here with the first trade, taken, as you can see, straight from the 1 minute chart. What we're looking at here is a textbook example of a failed higher high in the context, obviously, of this dynamic up here. As you can see, price tries to push past the previous high but stalls out, setting the stage this way for a liquidity grab and a sharp reversal. But first, look at this whole area here. Price is oscillating in a relatively large range. It then makes a decent attempt, as I just mentioned, to break above this previous high near 490, but it immediately fails. This is our first big clue. Now, that failure, especially on such obvious bullish momentum, isn't, in my opinion, just a pause. It's a sign, rather, that market makers are actively absorbing orders at that level. And the subsequent move here, I think, is even more critical, because we don't get a slow grind down at this point. Instead, we get a series of impulsive supply bars with this upward retracement, which is masked, as you can see, as a relief rally, when in fact, this is just another liquidity grab at this 420, 450 directional liquidity point. This tells me, guys, that this whole down move isn't a natural correction. Why? Well, because a natural correction, as we all know, would have slower, more measured price action with a genuine relief rally or rallies. This was clearly an outright nosedive. So why such a puke lower? Well, my read is that the real intent or target by the market makers was never these range highs. The true, actually, objective was down here, the swing lows. The reason I'm saying that is because the initial push to 490 was likely, in my view, a move to inject optimism and then trap longs, creating this way a pool of buy stops above the immediate range. Once those stops were run, the market reversed sharply to hunt for the other side, the sell stops sitting just below these obvious lows. You can see it play out perfectly. Price doesn't just gently touch the lows, it sweeps them rather aggressively. And this way, by sweeping them aggressively, they take out both of these key levels and even printing a new low. This is how market makers, guys, efficiently hunt down and collect all available liquidity, sweeping this way stop orders across the zone with, I should say, precision. And this is where the trade, in my view, starts to set up. This clear sweep of the lows often marks for me range exhaustion and obviously reversal. What that means is that market makers have achieved their goal, and the market, as you can see, is now left imbalanced. And we immediately see evidence of this with a strong reaction via this cluster of strong demand candles, showing clear buying pressure as the market reprices higher. By the way, here, this isn't, as you can see, a half-ass bounce. It's a clear sign of downside rejection. In fact, the market tried to go lower with a lower low here and was rejected. A rejection, mind you, that was followed by a clean reversal, that created in the process a bullish imbalance right around that 420 level. Now, my thinking here was pretty straightforward. As long as this directional liquidity point or imbalance, the same thing, held, meaning price didn't fully break below its base with a solid candle close, the setup for a long on the retest remained, in my view, valid. That's why I took the entry just above the 430 level, aiming for the main imbalance zone sitting above 465. As you can see, the trade played out really well overall. Now, my last contract obviously didn't hit its target, so I ended up getting stopped out. But the setup, I thought, was clearly aligned with the right direction, and despite that last piece folding short, I closed the trade green, and that's what really matters. All right, with that trade wrapped up, let's now move on to the next one. So what we're looking at here is a 15-minute chart showing price after a long accumulation phase leading to a strong 350-point move to the upside. The market then peaks around the 900 level, and then sharply reverses and dives down to test the 550 support zone. Now, once I saw that possible shift in momentum, I started drilling into the lower time frames as I usually do, and eventually settled on the 15-second chart. Now, the 15-second time frame gave me a much clearer view of the internal market structure and helped me at the same time pinpoint where the next opportunity might unfold. Now, my thought process here was simple. If this flip zone we got here, which also, as you can see, aligns with the base of this imbalance, would hold on, this potential retest, a high probability scenario in my view, given the stop run below the 517 support and the subsequent break of market structure at 560, if this flip zone would hold, I thought it would present an optimal long entry. And sure enough, the flip zone held up nicely, validating this way my analysis. You can see how solid that support level was, since the trade hit two of my targets in a very clean way. Now, the third target didn't quite get there, and I ended up getting stopped out on the last contract. But overall, gang, I closed the trade in profit. And again, at the end of the day, that's always the goal. By the way, guys, if you found these strategies helpful, don't miss my next video where I'll break down more simple and high probability setups you can use right away. All right, thanks for watching, and as always, hope to catch you all in the next one.